Hello, welcome to this Q1 2023 update of the Managed Portfolio Service managed by AJ Bell. My name is JB Ward. I'm Head of Investment Solutions here at AJ Bell. This should be fairly typical, fairly familiar for most people who have watched this in the past, but we'll basically run through what we do here at AJ Bell, the kind of core investment offering. I'll then run you through some of the performance. What are they kind of the drivers, particularly in the last 3 months, and how that's changed compared to it during 2022, and sort of round it off with a portfolio performance review that takes into account some of the things that are some of the interesting things that have been happening in the markets during 2023, with a bit of a kind of overview of where we see things going in the future. So at AJ Bell, we run two types of portfolio. We want what we call the growth range and the income range. The growth range are risk-targeted portfolios that are designed to behave in a manner that is predictable, depending upon which portfolio people are in. And by predictable, we mean predictable with regards to volatility. We gold match to Dynamic Planner's DT range. Dynamic Planner have 10 ranges, but we just take the middle 6, which is DT3 to DT8. This makes up our 6 risk profiles, which we refer to as MPSs 1, 2, 3, 4, 5, and 6. There are a number of different ways we can implement these portfolios, most popular of which is the passive MPS. Now, it's called passive MPS, but that doesn't mean to say we're doing passive management. We're doing active management. We're just using passive implementation to make it as cost effective as possible. We also have a blend of active and passive, which we refer to as pactive. We have a pure active for people who would like their implementation to be also active, as well as the actual asset allocation itself. And for investors who are interested in responsible investing, we also run a responsible MPS range. All of these different types of MPS all run off the same asset allocations, just with different implementations. We also have what is effectively a unitized version of the passive MPS, which we refer to as our growth fund range, again, running through all 6 of those risk profiles. So that's 5 different ways of implementing 6 different risk profiles. That gives us 30 actively managed growth portfolios. In addition to that, we also have a responsible growth portfolio, which, like the responsible MPS, is for investors who are interested in responsible investing principles. But in this case, it matches to DT7, i.e. has the same asset allocation as our MPS 5. On the income side of things, we have 2 different types. We have what we refer to as income and growth. Income is there to provide purely income, and income and growth is also to add a bit of capital protection through the growth of the portfolio. Together, these portfolios are designed to yield somewhere around 4% per annum, between 3 and 5. Again, we have a passive implementation of these portfolios via the passive income MPS. We have an active income MPS. We also have 2 more income funds, given 3 more implementations, a total of 37 different portfolios, 31 growth portfolios and 6 income portfolios. So this is the performance of the portfolios for the last 5 years, but also including the last 3 months. Now, things to note here. Firstly, 2022 was a very, very difficult year, but in the last 3 months, we've certainly had an uptick in markets, both the bond market and the equity markets. Also of note on here is the 3-year figures, which are annualized. So that's the return on a per year basis. They look notably higher than the 1 year and the 5 year, all of which are annualized figures effectively. The important thing to note here is the performance figures we're giving are to the end of March 2023. So if it's a 3-year figure, that means the start date is at the end of March 2020, which was right at the bottom of the COVID sell-off during 2020. So those figures in that 3-year annualized, whilst very, very attractive, are possibly flattered quite a bit by the fact that the market was at a low ebb at the time. Nevertheless, the 5-year figures we think give a probably more accurate reflection of what we would expect to see the portfolio's return over a long period of time. One other thing to notice here is passive MPS 6 in the last 3 months has slightly underperformed passive MPS 5. The reason we think this has happened is because both passive MPS 6 and MPS 5 are very heavily weighted towards equities. However, passive MPS 6 has much more of a global growth mandate, so it's invested much more in emerging markets and less in the developed markets, whereas MPS 5 is much more developed market focused. Because the developed markets have outperformed in the last 3 months, so therefore the MPS 5 has also. On the active side of things, the performance is slightly underperformed the passive, with it proving to be a very, very difficult market, actually for the last 3 years, but particularly in the last year or so, for active portfolio managers to outperform passive. So, and we've noticed that in our implementation also. Pactive, as you probably might expect, is something like a blend between passive and active. So it's slightly more expensive than passive, but less expensive than active. But it has a degree of additional active in there, and it's proving quite popular for us. Talking about the drivers of performance, the big change we've noticed in the last 3 months, particularly on the equity side of things, is there's been a strong outperformance on what's referred to as quality equities. Quality equities are equities that have high returns on capital and therefore attract quite high valuations. Their antithesis is value equities, which tend to be lower return on capital, but tend to be quite cheap looking. See, in the last year, in 2022, value was a strong performer, strongly outperforming quality. And this just gives some indication of some of the reversal we've seen, which we'll talk a little bit more about as we go through the presentation during the last 3 months. Also of note on here is the bond market is not entirely what you would call directionless, but there's very little trend to spot with regards to what is doing well, other than to say that long duration fixed income over 2022 was quite a poor place to be, but has improved quite a lot this year. And then finally, on those two charts on the right hand side there, what they're showing is that large businesses are outperforming small businesses in contrast to what happened during 2022. Now, this is effectively saying a lot of what the first chart is saying, because a lot of the quality businesses tend to be very, very large. Moving on to other market barometers, what we can see on here is that the equity market during if I point to the third from the left lower chart, you can see that during the last year, the equity market and the bond market have performed more or less in line with each other. Now, it didn't necessarily feel like that because it was a very, very difficult market for the bond market. So what was an untypically poor year for the bond market was sort of what felt like a slightly more normal year for the equity market. And therefore, whilst it felt very bad for the bond market, it was equally quite uncomfortable for equity investors. The problem with that, of course, is the low risk targeted portfolios tend to be heavily weighted towards the bond market. So therefore, investors who were expecting a fairly easy time of it were shocked to see that the bond market was really quite poor. What we've noticed this year is we've had bond market and equity market rising in tandem, but the equity market has outperformed. What that means is that the equity risk premium, which is the premium of return you expect to receive on equity for the additional risk, has continued to contract. So you're getting less and less additional return for taking that equity risk than you are over bond risk than was perhaps the case maybe 18 months ago. So as an economic review, what we're really seeing here is a partial reversal in trends. Last year, there was a lot of poor performance in anything that was long duration. Long duration means highly interest rate sensitive. So that could mean quality businesses, it could mean growth companies, it could mean very long duration fixed income. So things like index-linked bonds were very poor. In terms of economics, the growth across the Western economies has proved okay, but we wouldn't go any more enthusiastic than saying the word okay. If we go back to, say, Q3 of last year, when sort of gloom about the markets was probably at its highest, there was a lot of talk about the potential for what's sometimes referred to as a hard landing, i.e. when we fall into a nasty recession. So far, that doesn't seem to be the case. Whilst you would hardly say that the growth has been unspectacular, it has at least been positive. Inflation, which has been a big story, has started to come down, but this is completely as expected. A big part of what caused the inflation last year was the Russian invasion of Ukraine, and particularly the kind of fallout onto the markets. So the most obvious of which was a spike in the oil price, but also because of the various sanctions and counter-sanctions, it meant there was a large amount of commodities that was effectively taken out of the Western market, pushing their prices up. It always seemed likely to be the case that once you had that initial spike, even if prices stayed where they were on the spike, you wouldn't have high inflation, because there's an annualizing effect, which unless inflation keeps going up, then inflation will flatline. Nevertheless, there continues to be questions about inflation's path. During the COVID period, when we had a significant stimulus from many Western economies, a lot of that was funded through quantitative easing, which is basically injecting brand new money straight into the economy. To start off with, we didn't see much of that inflation because most people were still effectively locked into their homes. The question is will that inflation, once we look through what's been happening in Russia and Ukraine, will that inflation persist because of what happened during COVID? And that remains a live debate. For now, the bond market appears to believe that inflation is coming down, and as a result, we have had quite a bit of a bounce in the bond market. So here we can see some of that reversal. These are the equity performance during the last quarter and the last 12 months. Now the charts on the left are somewhat interesting, but the charts on the right are much more interesting. The charts on the right are equity factor performance. So this is the types of business, not types in the sense of technology or energy, but types in the sense of, are they a growing business, are they a quality business, do they pay a big yield, that kind of thing. What you can see here is there's been quite a reversal in which ones have done well and which ones have done poorly. So the second worst performer in the last year is actually the best performer in the last 3 months. Now remember that last 12 months includes this previous quarter. So that 12% positive performance in growth is taken out of the 12 months of the previous 12 months. Which means if you take out the current quarter, the growth type businesses in the previous 9 months must have fallen 16%. That's pretty significant. Overall, what you can see from that cross of blue lines is effectively saying the stuff that did really well in the last 12 months has done really quite badly in the last 3 months, and vice versa. The only outlier there is what we call momentum. Momentum is effectively a strategy in investment markets where people buy things that are going up and sell things that are going down. The fact that momentum is doing so poorly suggests that markets are pretty directionless, which sort of speaks to that uncertainty about the future path of things like inflation. In other words, people can't determine what are the best places to be invested for the long term right now. You can also see this reversal in the bond market. Now this time it's more interesting on the left two charts, which is about the maturity breakdown. Here, the reversal is even clearer. So during the last 12 months, the very worst performing segment of the maturity bucket of bond investments has been the best in the last 3 months. And it's true all across the board. So best has gone to worst, second best has gone to second worst, middle has stayed where it is, etc. What's happened there is that because we've had much higher inflation last year, we had a very, very poor bond market. And you can see that particularly in that 10 plus bracket on the bottom left chart. As we've gone into this year, and as already mentioned, people are beginning to price in lower inflation. And as a result, there's been a bit of a jump in those worst performing segments of the market. Now, that jump is nowhere near big enough to offset the losses in the previous 12 months. But nevertheless, it has shown that there's been kind of change in attitude in markets to where one should be invested. Moving on to currencies, the big narrative last year was that sterling had been very, very poor. The problem with that is when people talk about sterling, they're usually talking about sterling versus the dollar. Now, of course, we don't necessarily just invest. So when we're measuring how sterling is done, we don't necessarily just look at the dollar. What actually happened last year is more than sterling weakness. What we were really seeing was dollar strength. So in that bottom chart, those last 12 months, you can see that the second best performer against sterling was in fact the US dollar, and that's what people were looking at. But if you compare sterling versus, for example, a Japanese yen, which is a very, very important economy, sterling actually outperformed yen. So it's not fair to say that sterling had a uniquely bad year last year. What it is true to say, however, that sterling is very good this year. Sterling is outperforming all major currencies in the first 3 months. There is also some strength in the euro market, where the euro had a pretty good year last year and continues to have a good year this year. And that's also reflected in the equity market, with the European equities being the best performing equities in the world. One of the major stories in the first quarter of 2023 was the surprise number of bank failures. Bank failures is something that we thought we'd probably seen the back of, especially since what happened during 2008. But these bank failures seemed very, very unusual. And there was 4 bank failures in total, 3 in the US and 1 in Switzerland. Now, we don't necessarily see them as one event. We see them as 2 separate things that happen to have happened at the same period of time. In the US, there was 3 banks that went under. One was called Silicon Valley Bank, another Silvergate Bank, and another one called Signature Bank. Now, all these banks had gone into a situation where their funding was becoming difficult to get hold of. If we think about the background of what happened, we've had this high period of inflation. To combat that inflation, interest rates have risen. As a result, bank balance sheets have become slightly strained because the asset side of the balance sheet has compressed slightly to account for these compressed in value rather, to account for these increased interest rates. During February of this year, there was a rating agency called Fitch in the US, highlighted that several US banks, including the 3 just mentioned, are subject to those slightly declining asset values, but also have a very large number of wealthy depositors, i.e. these were banks that rich people tended to use. Now, in the US, there's something called the FDIC, the Federal Deposit Insurance Corporation, which is effectively an insurance corporation run by the US government, but funded by the banking system. And it exists so that if a bank goes under, deposit holders are insured, i.e. deposit holders receive their money back. But it's capped at $250,000. In the cases of these 3 banks, the depositors in many cases had much more than that. In the case of Silicon Valley Bank, for example, the average depositor had $2.5 million. Now, Fitch, when they put out their note, said that these are a bunch of banks. They're not looking quite as good as they used to. And if the depositors started worrying about it, it wouldn't take many depositors to take their money out before these banks got into trouble. But the problem is saying that is it forced people to reassess the strength of these banks. And therefore, the knowledge that those banks weren't quite as strong as some other banks meant that depositors started pulling out deposits. I.e., there was a degree of something called reflexivity, where the knowledge that something could happen caused the thing to happen. Now, that's all well and good and fairly interesting, but the US banking system, in fact, all banking systems, have all sorts of layers of funding and mechanisms to ensure that banks don't just go under because people take deposits out. There's something called the interbank market, where banks source funding from other banks, and also banks can source funding from the Federal Reserve, i.e. the US central bank. Now, these seem to have fallen over during this period. There was no interbank lending available to these banks, and the central bank seemed unwilling to offer funding over a short period of time. Now, it looks like this might be a politically motivated series of failings, because whilst it's true, all these factors, these negative factors, were true of these banks, it was also true of some other banks, not most notably of which was one called First Republic. Now, First Republic had arguably a worse balance sheet than the 3 that failed, and it fell into the same problems where depositors were withdrawing money. Now, in the case of First Republic, it managed to source $30 billion from a coalition of 11 banks to shore up its balance sheet to ensure that it didn't have to have issues with funding. Okay, so the differences between the 3 banks that went under and First Republic was that the 3 banks that went under were all heavily involved in the crypto market. That's that they were provided banking services to things like crypto exchanges. Now, it's fairly well known that the US government is not a big fan of the crypto market, because the crypto market, if it delivered on its promise, would effectively be a currency outside the control of the US Federal Reserve and the US government. And therefore, you can see why they wouldn't be particularly keen on people using cryptographic currencies. So it seems likely that, yes, it is true that these 3 banks had got into a spot of bother, but they didn't need to fail the way they did. It seems that they failed the way they did because the US government was unwilling to allow them to be rescued. In the US, things were even stranger. For some reason that no one can really seem to explain, during the last quarter of 2022, Credit Suisse, which is the 2nd largest bank in Switzerland, or rather it was the 2nd largest bank in Switzerland, saw deposit outflows in excess of 100 billion Swiss francs, which is about a third of all of its deposits. This is an enormous amount of deposits to lose in a very short period of time. And the Swiss government tried to support Credit Suisse by injecting central bank liquidity in there. But for whatever reason, people began to panic about the sustainability of Credit Suisse. So the Credit Suisse's then management decided it would be a good idea to try and shore up the balance sheet via what's called an equity raise, i.e. create a much larger buffer of equity to ensure that the banks appear safer to people. Another weird thing that happened is the second largest shareholder, which is the largest independent shareholder, the Saudi government, refused. They refused to inject additional equity capital in Credit Suisse. Not only did they refuse, it was quite publicly that they refused, so that the Saudi government effectively signed the death warrant for Credit Suisse, a business in which they were a significant investor. Very unusual thing to have done there. The next strange thing that happened is the Swiss government arranged for Credit Suisse to be bought by the largest Swiss bank, which is a bank called UBS. Now, as part of the negotiations, UBS effectively held the whip hand over the negotiations because they would only wish to buy Credit Suisse if there was something in it for them. And Credit Suisse had a type of debt on their balance sheet called an AT1, or Alternative Tier 1 Capital. This is a high-yielding type of debt that in the event that a bank fails usually gets what's called bailed in, i.e. wiped out, but only when the equity holders have also been wiped out. So UBS, their bung that they effectively received from the Swiss government was to allow them to default on Credit Suisse's AT1s. Now, to put it into context, what that means is UBS were effectively given 1.5 billion Swiss francs per year in perpetuity because that was the cost of servicing that debt. Weirdly though, the equity holders in Credit Suisse, whilst they lost nearly all of their money, they weren't entirely wiped out. Capital structures, so that were wiped out first, shouldn't have been wiped out first, the way things are supposed to be designed. This caused a little bit of stress in the high yield market in the Eurozone, but it seems to have somewhat abated since then. What we would say about banks overall is, compared to 2008, bank capital ratios are systemically very, very strong. It is possible that bank capital ratios are as strong now as they have been to any time since the 1960s. However, banks remain political footballs, and the events of the last 3 months, really of anything, just highlight the importance of having a kind of broad attitude to investing, where you invest in whole sectors rather than trying to pick out individual winners. So just to conclude things now, inflation is definitely coming down, but this isn't a surprise because it's largely down to what's called the annualizing effect, i.e. we had high inflation, and without having prices continuing to go up at the same level, inflation will go down naturally on its own. The debate really is about what next for inflation. How much of that stimulus from 2020 will remain in the economy, and how persistent will that force inflation to be? We believe that the future in markets is particularly uncertain at the moment. It's somewhat of a cliche to say that the future is uncertain in markets, but it is particularly the case right now. And for us, this highlights the importance of not trying to be too clever with our investing. So for that reason, we are much closer to our core strategic asset allocation and not taking any tactical positions as of right now. You can keep up to date with the MPS service on the Invest Centre website, and you can find all sorts of information on there, including presentations like this. Thank you for listening to this Q1 2023 MPS update.